Traditional financial institutions are currently executing a direct integration with digital networks and tokenized wrappers. BlackRock's 2026 investment thesis outlines a shift in asset management. They project that institutional and wealth portfolios are moving toward a blended model, merging public equities and fixed income with private markets. The boundary separating traditional finance from decentralized finance is collapsing. Asset managers are migrating capital on-chain to capture algorithmic efficiency, faster settlement times, and programmable logic. This line chart visualizes the global decentralized finance total value locked. Institutional capital has driven this metric into a sustained $130 to $140 billion range. Within that aggregate total, $17 billion represents institutional real-world assets, expanding on a steep growth curve. Yield-bearing stablecoins and tokenized treasuries are actively replacing traditional fiat currencies in institutional treasury strategies, offering automated on-chain yields averaging near 5%. Processing this volume of tokenized capital requires a structural settlement layer capable of clearing massive data throughput without delay. Sustaining this $140 billion converged economy depends entirely on blockchain infrastructure that can process institutional-grade volume without incurring prohibitive network costs. For years, basic on-chain actions cost users up to $50 per transaction. Recently, the network cleared the congestion that previously choked its blocks. On January 17, 2026, the Ethereum mainnet processed 2.6 million transactions in a single day without triggering a network queue. The cost to execute these transactions dropped to a baseline of exactly 1 cent. This pricing effectively ends with $50 gas era that historically prevented everyday users from relying on the mainnet for basic financial operations. The fee reduction followed the late 2025 structural upgrade known as Fusaka. The network successfully scaled to handle the data availability demands of its users. However, this pricing victory masks a mathematical bottleneck looming over the base layer execution engine. To understand the fee drop, we have to look at how Ethereum divided its workload. This map shows the network's modular structure, a central mainnet highway acting as the settlement layer, with elevated networks, known as Layer 2s, routing traffic above it. Layer 2 networks like Arbitrum or Base process thousands of individual user transactions off-chain, absorbing the computational heavy lifting. They bundle these transactions together and post them back to the mainnet as highly condensed data packages called blobs. To process these blobs, developers introduced a mechanism in 2026 called Peer Data Availability Sampling, or PeerDAS. PeerDAS allows validators to confirm the data exists by checking only tiny fragments of the package. They no longer have to download the entire multi-gigabyte file. By decoupling the massive storage requirements of data from active computational execution, the network drove user transaction fees down to a single cent. Modular scaling permanently solved the network's data availability problem. It achieved this by deliberately ignoring the harder problem of base layer computational execution. With data storage outsourced to Layer 2s, the pressure shifts back to the core base layer execution engine, where final settlement actually occurs. Every 12 seconds, the mainnet generates a new block. The amount of computational work it can perform in that window is capped by a strict mathematical ceiling known as the gas limit. This data table illustrates current execution capacity. The network coordinates around a 60 million gas limit per block, translating to 5 million gas per second. Applying this reveals a hard ceiling of 238 transactions per second. Simply turning up the dial to a higher gas limit breaks the network architecture. Pushing the gas limit higher causes network latency. It overloads the validators, strains the memory pool, and degrades the pipeline used to sequence transactions. Social scaling, asking the existing decentralized nodes to simply compute more data in the same 12-second window, has hit a mathematical wall. If institutional liquidity continues to scale, this bottleneck will choke the settlement engine. To shatter the 60 million gas execution ceiling, Ethereum relies on a slate of radical architectural changes grouped under the roadmap codename Glamsterdam. A central piece of this roadmap is EIP 7732, or Enshrined Proposer-Builder Separation. This physically splits the validator duties into execution validation and consensus validation. It introduces a deliberate time delay, decoupling the complex math of executing a transaction from the network-wide agreement on its validity. But separating the builder from the proposer is not enough to reach the high-end goal of processing 200 million gas per block. To hit those targets, the network is proposing to abandon traditional block re-execution entirely. Instead of every decentralized node doing the math themselves to check a transaction, the roadmap requires a transition to real-time proving. Validators will simply verify a zero-knowledge cryptographic proof, a dense mathematical receipt proving the execution was done correctly by a third party. Relying on ZK proofs changes the network's verification model. It trades the independent mathematical re-execution of thousands of nodes for cryptographic trust in a single proof. We have to examine the stability of this architecture. Scaling execution this high places immense weight on the reliability and availability of the proving market. The Ethereum Foundation sets strict feasibility constraints for these zero-knowledge proofs. They must be generated in real time, remain under 300 kilobytes in size, and maintain 128-bit security. Generating proofs under these constraints at network speed requires immense computational power and highly specialized, expensive hardware. To supply these cryptographic receipts to the validators, an entirely new layer called a proving market will emerge. This creates a systemic risk. If only a few highly capitalized actors can afford the hardware necessary to generate the proofs, the validation market inherently centralizes around them. A centralized proving market recreates the institutional dependencies and structural bottlenecks that decentralized finance was originally built to escape. Outsourcing base layer execution to a specialized proving market risks recreating the same high-tier hardware requirements and service dependencies that decentralized finance was intended to bypass. Pristine theoretical cryptography models rarely account for the chaotic reality of global financial markets. The separation of execution and consensus introduces temporal slack, a delay measured in seconds. This creates what researchers call the free option problem. Academic models indicate that under conditions of high market volatility, block option exercise failures could spike to 6%. These failures directly threaten network liveness, the fundamental ability of the blockchain to continuously process blocks and settle transactions without freezing. These network freezes are modeled to occur precisely when institutional capital is panicking and requires immediate liquidity. The 2026 landscape is defined by an architectural divide. Data availability successfully scaled, driving fees to a penny, but high-end execution scaling remains deeply perilous. $17 billion in tokenized real-world assets are currently resting on this infrastructure. Securing the next $1 trillion in institutional convergence depends entirely on whether experimental zero-knowledge proving markets can maintain liveness under the brutal weight of a global financial panic.